Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of On Holding. And what is On Holding for those who don't know? Essentially, their big thing is they make shoes. They are essentially a company that makes running shoes first and foremost, or things such as tennis shoes. And they also do a few other styles of shoes. And recently, they've had apparel as well. So, if you look at the distribution here, shoes are the grand majority of sales. It's not even close. And then apparel and accessories does a little bit more of their grand total, but really not that much. And you'll see here where every category is growing. Funnily enough, accessories grew the most, but even then, shoes are growing more than apparel. So that's still their largest segment. They're growing, and they're growing by quite a bit. Overall, as you see here, the revenue grew by 20.9% between 2023, the first quarter, and 2024. So that's monster growth so far. So far, so good. Now, let's talk about the 3 month period ending March 31st, 2024. We're going to compare it to the previous quarter there. This is all in Swiss francs. You can convert it to dollars if you so desire. I am going to for my valuation because they are listed in the New York stock market. So, their net sales up significantly. Their gross profit up significantly. Their operating profit down a little bit. So selling general administrative expenses are actually up. And then we get here to net profits where they actually get a gain on foreign exchange. So that's something interesting because if you are wanting to look at earnings per share, their earnings per share were probably way better than expected because of this foreign exchange. But you can't rely on this foreign exchange to be favorable every single year. Even though Swiss francs are pretty generally stable, you cannot expect a 76 million Swiss franc gain every single year when the year before, or every single quarter, when the quarter before was 8.8 million only. That's just something to note. And oftentimes that number can easily turn negative. But overall, you have pretty good income before and after taxes, pretty much doubled, right? So overall, the picture is great for on at least in this latest quarter. You also look at just the current assets being 1.36 billion Swiss francs compared to really the current and non-current liabilities, which add up to pretty much 700 million Swiss francs. So you have way more in just current assets, which includes cash and includes other things. Inventory, of course, is a little difficult because it's an asset, but usually to get rid of it, you have to sell it at a discount, but not always. So it's still an asset there, but they don't have things such as goodwill, which are actually sort of expenses in the long run. So this is pretty good. And even here in the expenses, they really don't have a lot of debt, especially not debt that couldn't be covered with the cash immediately. Their current liabilities can be covered with just cash or current assets with no issues. So that's great. And if we look at some supplemental stuff, here we see something that gives me a little bit of concern. From 2019 all the way till their last report, their shares outstanding have actually pretty much gone up by 50%. So they went from 234 million shares to 322.2 million shares. They're issuing shares. Why do we care about this? Well, if you're an owner of a company and a company is issuing more shares, the percentage of the company that you own is less and less every time. If you're investing to be an owner of a business, you care about dilution. And investing in small companies is often related to them growing quicker than they can dilute you. So this is something important. Yes, On has had really great growth, but they're also diluting you a little bit. The gains wouldn't be as much as if they weren't diluting you. So that's very important. And the dilution has been very quick. So it doesn't look like it's stopping quite right now. And another thing to note is their total debt and their net debt. So their debt picture is growing. That makes sense. They're probably gearing up to make an acquisition as well. But their net debt is also going lower and lower, aka they have way more cash than they have debt. This is good. So overall, we're not worried about the debt. Pretty healthy cash position. Great to know. Now, if we look at the free cash flow, here we have a way more mixed bag. So essentially, cash from operations was often negative, all the way really until 2023. Before that, look at this change in inventories being these monstrously negative numbers, which is fine, but stock based compensation. In December 2021, they issued $210 million worth of stock, which is listed here as a positive, but actually, you have to discount that from the cash from operations because at the end of the day, that is an expense for the company. So, cash from operations here wasn't really consistently positive until December 2023. In this latest quarter, it's been positive. So, that's a really good thing. So, it seems like they're going to be cash flow positive from now onwards. And then you have the capital expenditure, which is growing, but essentially, cash from operations should be way more if they're doing healthily and if they're not having anything crazy going on with inventories or stock-based compensation, which thankfully the amount that they issue has died down since 21. Okay. Now, how do I value a company that has negative free cash flow, generally, sometimes positive, with a discounted free cash flow model? Where there's two ways you can do it. One is I can grab this last year of free cash flow, say, okay, they turn about 9% of their revenue to free cash flow, and I just grow the revenue and just say they're going to do that 9% in perpetuity. Another one is to compare it to peers in the sector. And I am going to do a little bit of both. So again, here is the look the look that you get. And you can also see that in the trailing 12 months, which includes this latest quarter, you can see that the cash from operations has gone up, the capital expenditures has gone down. So the picture so far seems like they are going to have positive free cash flow again. One can hope, of course, if one is investing in a company for the cash that it generates. So, to do a model, I'm going to do a mix of both of these methodologies. I looked at companies like Wolverine, Skechers, Crocs, and sort of try to figure out what does normal free cash flow margins look like for them? What normally do they grab? What percentage of revenue do they normally turn to free cash flow? And it generally oscillates between sort of a 8 to 10% for companies like Skechers, for example, to a monstrous 30 to 40% for Crocs. So what I'm going to say is right now they're at that 9% and they haven't like actually generated much cash flow so far, but I'm going to give them the benefit of the doubt and say that they improve a little bit. So let's put that at a 15% just to be conservative. They're going to do better than some traditional shoe companies because they're lean, they're innovative, but they're not going to do as great as Crocs because they still have a lot to learn. They're not nearly as mature as Crocs, for example. So I'm going to say 15% of revenue is going to be turned to free cash flow from 2024 onwards. Then I'm going to grow revenue by essentially what analysts estimate, which is about 20% in 2024, 2025. Then I'm just going to grow it by 15%, 2026, 2027, and then in perpetuity by 5%. Okay? My required rate of return for this model is 11%. Now, with that said, I get a value divided by the total number of shares out. The fair value of equity that I actually get is $27.29. Now, this is in dollars, note, and I am converting all of these from Swiss francs to dollars. Then, if we subtract the net debt, so we are subtracting a negative that's actually a positive, I'm adding a little bit to the value, so the value post debt is actually $28.36 with net debt included. So let's look at where on stock is. So seems like it's nowhere really where this calculation goes. And it hasn't really been in that level since 2023, pretty much. So what's going on here? Well, one of those things is you can see this P/E ratio of 100, which even in a quarter where they did amazingly in earnings per share, they also issued a bunch of shares. So that keeps the P/E very high. You can see that the market cap is pretty low, so there's a lot of room for growth here, of course. Growing from 1 to 10 billion is easy, even 10 to 100 billion can be interesting. 100 to 1 trillion, that's a lot harder, at least at sort of the growth rates that people expect. But yeah, I mean, they've been public for not that long, really. And if you're an investor, an early investor in On, you've only done a little bit good. You haven't beat the market actually, but from now onwards, it could be interesting at the right price point. If you invested at the beginning of 2023, you're probably very happy with your investment, for example. Now, this price doesn't quite match what I got. And to match it, I had to actually increase the perpetual growth rate to 7.5%. So I have to say on it's going to grow for the rest of time, basically, for the rest of eternity by 7.5%. Now, I'm not going to do this. And the reason why is because I want to be reasonable and conservative. And this 45.35 does roughly match this, but that's the expectation that the market has. Any disappointment in that can easily tumble the stock down. And At the end of the day, running shoes are great and everyone should own a fantastic pair. But if there's a recession, I don't think people are going to be running to buy their running shoes. No pun intended. They are probably going to need to buy work shoes first and foremost, or just cut that spending as a whole, use their old pairs of shoes if people lose income. So that's very important to note. So, all in all, On seems to be a great growth story with some awesome fundamentals so far. I mean, everything is strong in many ways, especially the growth rates and the fact that they can more than cover any liabilities that they have. But the share dilution is so concerning. Shares are more than doubling and actively taking from free cash flow. They're issuing so many shares, it's kind of crazy. And due to this, valuation simply does not get there for investors who have a risk first approach. You want you want them to grow faster than they can dilute you, and the problem is, if you don't believe that they will, there is a problem there. Besides, people will also be less keen to buy their products in a recession, as I was saying. So you need a little bit of a margin of safety that for me is simply not present. And I know you may say 5% in perpetuity is a little bit of a disservice because they've been growing closer to 20, even sometimes 60% lately. But I want to account for down years as well. I want to account for recessions. I want to account for the fact that growth is going to slow down eventually. So that's simply what I'm going to do with my model. And with that, plus the dilution, to me, it looks like something where I'd have to wait for the right price point. So owners care about dilution. I think that's the lesson here. If you want to actually be a business owner, you don't want to be diluted by this company. You actually want your ownership share to grow. If On was buying back stock instead, the valuation story would be different. But unfortunately, so far, it is not. Now, I thank you so much for watching. I hope you had a lot of fun watching this video. I had a lot of fun analyzing on stock. So I hope we can track it in the long term. If you want me to see any other companies, please comment down below and don't forget to like and subscribe. Thank you very much for watching and have a great rest of your day.